Thank you for inviting me this evening. Good evening. I appreciate the opportunity to share some of my thoughts on the financial services industry that we are all working in. You know, like all sectors, the financial services sector is in the middle of substantial transformation. And successful organizations are those that understand what change needs to be made and make that change. Carly Fiorina, who was the former CEO of Hewlett-Packard and also was a nominee for the Republican nomination for presidency of the United States in the last go-round, she made this statement. She said, "The pace of change is so great, there's always something else going on." What that says to me is that you need to have strategic vision and peripheral vision. Strategic vision is the ability to look ahead, and peripheral vision is the ability to look around, and both are important. And organizations need to have a broad view of what is going on around them, how it impacts them, and then a strategy to be successful within those issues. Bill Gates, who is the founder of Microsoft, made this statement. He said, "We always overestimate the change that will occur in the next 2 years, and we underestimate the change that will occur in the next 10. So don't be lulled into inaction." You know, in reviewing what is going on around us, we have to be discerning about what we believe is going to be a successful venture to enter into and sort of who to attach our wagon to so that we make the best decisions with the investment dollars that we have. So in the minutes that I have tonight, I'm just going to talk at a high level around technology innovation and the changes that is driving in our industry. I want to talk about the banks a little bit and how they're responding to this changing industry. Look at member expectations and non-member views of the credit union system, transformation that is occurring within the credit union system itself, and then a brief overview of assumptions that we make, because our assumptions are extremely important in terms of the decisions we make and the strategies we build, and some of the expectations of millennials. So credit unions in Manitoba have been extremely successful over the years. You know, we enjoy the highest level of market share, and what I mean by market share is when we take a look at the total number of assets in Manitoba held by credit unions and chartered banks. Credit unions have 36% of those assets, and that is the highest proportion of assets in credit unions across the country. We have been amongst the leaders in asset growth over the last 2 decades, and Jim spoke about efficiency ratios. Credit union system in Manitoba has the lowest efficiency ratio, which is the cost to produce $1 of revenue, has the lowest efficiency ratio of any credit union system across the country. However, our environment is, we are in a protracted state of low interest rates, longer than we have seen in years, and that's what drives our low margins, and the margin is the difference between the money we get in on our loans and what we pay out on our deposits. It's the lowest margins we've had to deal with in years, and that's where we pay our expenses, is primarily out of that margin. We've got increased competition. We're going to see what the banks are doing and how they are focusing on our market, on the domestic marketplace. Greater innovation is required. Greater investment is required in technology in order to be competitive, and we have greater regulatory oversight, and we have increased compliance costs, all working together to create the environment that we are in today. Nothing remains static. The environment that we operate in is changing, it is dynamic, and we must respond to it, and if we're going to be successful, we have to respond to it effectively. And a big part of the change is driven by technology. So how many times is this asked by the public of us? If others can provide it, why can't you? The expectation bar keeps rising as technology improves. You know, we live in a world with what seems like an endless opportunities for improvements and change. I mean, that's what our suppliers of technology services are telling us. And in essence, or also that is what our members and the public are saying to us. This wheel indicates that technology possibilities drive innovation. Innovation changes business models. Innovation drives demand, and demand sparks new possibilities. But this wheel doesn't just go one way. It goes both ways. So demand will drive innovation, which will drive new advances in technology, which will change business models. And the responsibility of business is to understand this and respond to it. And part of the response has been the creation of what's been called fintechs. And they are financial technology companies. And they're primarily technology innovation that makes financial services more efficient, often by disrupting traditional models. So from a member perspective, a lot of this technology innovation leads to better, richer, easier services. From a credit union operational perspective, a lot of these innovations will lead to improved services, reduction of paper flow, which means lower costs, often support in terms of enabling compliance requirements, all sorts of aids in terms of running the business. The question really becomes, which of these business opportunities do you actually latch onto? What we have on the screen is a list of a number of fintechs that are offering services to the credit union sector. So there's organizations that help members join the credit union and onboard, as it's termed. There's organizations that provide online lending services. There's organizations that provide automated wealth management services. Services and advice for your wealth management needs that don't include actually meeting with people. It's all automated. So businesses need to decide which one of these is actually going to help me provide the service that my members are looking for. But probably over the past 15 years, the biggest technology change impacting service providers would be the smartphone. So Catalyst, this is a Canadian branding and marketing agency, in 2016 did some research on smartphones. And they determined that 76% of Canadians in 2016 owned a smartphone. And that's up from 55% in 2014. 85% smartphone owners / users who paid bills paid with an application as opposed to using the browser. So this begins to speak to the value of creating apps. And I know that you created a mobile app last year, I think it was, 2 years ago, I'm not sure. Past year, so 2016. So it speaks to the value of creating apps and understanding what apps members are going to want to use. Smartphone users, 52% of smartphone users deposited a check with their phone. That was in 2016. They didn't even have a number in 2014 because that service is really relatively new. So it shows the advancement of the service and also the advancement of the use of this service and of this technology in terms of getting financial services. These have big implications on financial institutions, because how services get delivered and what we call delivery channels becomes an extremely important issue in terms of how members are going to choose the financial institution they're going to get service from. Technology provides more and more ways for people to decide how they want to get service. The Canadian Bankers Association, which is in essence, the advocacy body for the big 5 banks. They did their own research on smartphone use, and they determined that 17% of Canadians said that the mobile, so their smartphone, was their primary method of receiving financial services. If you look at the bottom of that slide, it says, of people over 55, 17%, so the same number, said that getting services from a branch was their primary form of obtaining services. So we can begin to see the migration of how people want to receive their services. But does it mean that we don't offer branch services? No. A strong portion of our membership still wants to receive services from the branch. So financial institutions need to develop a multiple delivery channel service. So, if you think about it, we've gone from a branch service network where the majority of people did the majority of their business going into a branch. We migrated to telephone service offerings where people began to get services through telephones. We began to go online where people could get their services through their computer, and now we're moving to mobile. And we might expect that when one starts, the other one drops off. But it doesn't. All we keep doing is adding another channel delivery, another way to deliver the service, because that's what members want. And we go back to the challenge that we face. We have a low margin environment where the percentage of assets that we can now use to pay our costs is going down, and we have all of these cost issues that are driving our business. So how are the banks responding to all of this? Well, an organization called the Financial Brand puts out a publication called the Digital Banking Report. And in 2016, they surveyed a panel of over 100 global financial service leaders for their thoughts on retail banking and credit union trends and predictions. And they asked this question: what do you think will be the 3 most important trends for the retail banking industry in 2017? So the top 3 are, number 1, removing friction from the customer journey. Make it easy to do business with you, because that's what customers are looking for. The second is big data analytics. So we have all sorts of information at our disposal about members, about customers, the way people want to do business. And so the second highest priority here is analyze that data and determine what would be the best way to provide service to members. Now, if we want to step back on this, there's a balance in all of this, isn't there? What did TD just go through? TD obviously had tremendous amounts of data on their customers. And so they worked with their employees and said to their employees, when customers come in from various demographics or various income levels, these would be good products to sell to them. And they decided to create incentive programs for their staff to do that. I want to be very careful. I'm not criticizing this, because many organizations manage their sales force in this fashion. But what is important to recognize is that we have to be careful how we use the data we have in order to not be offensive to the people we're trying to serve, but actually in order to use it to help provide the service. The other high number 3 on this list is improved multi-channel delivery, and it's really what I've talked about. So if you take a look at what the people that were surveyed said would be the priorities coming up in 2017, it's make the customer journey simple, make use of all the data that you have and analyze it effectively to know what are the most likely successful products and services to provide, and then really understand the use of technology and how to gain efficiencies and manage your costs through the use of technology. And so when you look at the banks really focus on the use of technology. In fact, in Manitoba, so I talked about our market share at 36%. Probably from the early 1990s to 2012, we were continuing to grow in market share because our assets were growing faster than the banks. That is no longer the case. In fact, in 2016, banks were gaining shares in all areas but residential mortgages. So they are putting a focus back on the retail marketplace. They're opening innovation labs, they're partnering with fintechs, and that's really what this slide talks about, is the fintechs they're partnering with. They are using technology to reduce service costs, increase profitability, meet demands for those seeking simplicity, an easy way to get your business done, move lower value clients to lower cost channels. So if the client isn't bringing you lots of profitability, find a way to service them at lower cost. That's what they're looking at. And they want to reduce risk, losses, and insurance costs. What about members? So what are our members saying with respect to how much they are satisfied with the service offered by the credit union? And you reported here about the customers or the member services that you do. So we do an annual survey where we survey credit union members and bank customers. We ask a variety of questions, and I'm just going to report on one here. And this is the answer to the question, would you be willing to recommend your primary financial institution, your credit union or your bank, to a neighbor, a friend, a colleague? It's really called one-to-one marketing. And this slide outlines the results of that, the answers to those questions, and it's called a Net Promoter Score. So how you get there is, if to the question, are you willing to promote to a friend, neighbor, or colleague, on a 10-point scale, if you answer 9 or 10, so I'm really willing to do that, you're called a promoter. If you provide an answer between 0 and 6 to that question, you're called a detractor. So the Net Promoter Score is taking promoters minus detractors to get this result. And if you take a look, the left-hand side are credit union members, the right-hand side are bank customers. And if you take a look here, credit unions do extremely well on this Net Promoter Score, because although bank customers and credit union members are all satisfied with their financial institution, when I say all, mid-90s in terms of percentages, credit union members have a much higher very satisfied component. And it's this very satisfied component that actually aligns with this willingness to promote. So amongst members, credit unions are doing very well. So we measure ourselves against the banks. But who do the public measure us against when we're asking them about satisfaction levels? So if we take a look at, these are all well-known companies. All of these companies have a common value proposition of creating a simplified approach to the service and providing service at a better price than most of their competitors. People believe that this type of service should be available anywhere. So it goes back to that slide. If somebody else can do it, why can't you? I said I wanted to talk a moment about assumptions, and it links into the view of the public with respect to financial institutions. So Arthur Stinchcombe in 1965 wrote a book called Social Structure and Organizations, and he asked the question, why are industries that started around the same time still so similar in the present? And his answer is because of when and how the industry emerged and thrived, was successful. Organizational assumptions and culture develops that persists over generations. So he says that the last robust period of success of an organization will create mental models for people who are participating in this. It'll create legacies and assumptions and their worldviews associated with that experience. So we just took a look at one issue and identified one possible assumption. So what assumption do we have about the value and the attraction of the cooperative business model? So we are unique within the financial services industry in terms of our model. We have a democratic decision-making model. You have the opportunity to come and attend an annual meeting and vote on a number of issues. We have members, our owners. Some credit unions choose to provide patronage rebates, which is rebates based on the amount of business that's done with the organization, and there's local decision making. And what this tends to result in, amongst other things, strong member relationship focus. We constantly say that our primary objective is member service, that we make profit to provide services. We don't provide services to make profits. We need to make profits, but it's so that we can meet regulatory requirements and innovate. We also, as a result of this model, have robust branch networks. And we have members say in major change. We want to make major change to our organizations. Members vote to see if they decide that that's what they want. This has clearly contributed to our success in the past. But what about the present and the future? There are clearly generations of people in this province that are highly supportive of the cooperative model because of the successes that we have seen as a result of it. But will future generations want what this model offers, and will they have the same view of its value? First Data Corporation is an organization out of the US, and they did a study and wrote a paper called "There's No Slowing Down Millennials." So millennials it's a term that's used regularly, and it's really for a group of people that were born between 1981 and 2000. So for our purposes, it's people aged 17 to 36 years old right now. And First Data did some surveys with this group, specifically related to financial institutions. So 71% said they'd rather go to the dentist than listen to what banks say. 33% believe they won't need a bank in 5 years. 71% consider their banking relationship to be transactional, not relationship driven. And 33% are open to switching banks within the next 30 days. By 2020, the oldest group of millennials will reach their peak earning age, and I think along with that will have growing needs for financial services. Goldman Sachs did a survey in the investment world, and they said millennials have been slower to marry and move out on their own, and have shown different attitudes to ownership that have helped spawn what's being called a sharing economy. So what impact does that have, or is that going to have, on financial institutions? They're also the first generation of digital natives, and their affinity for technology helps shape how they shop. They're used to instant access to price comparisons, product information, and peer reviews. How does that impact financial institutions and how they're going to want financial services? In the 2011 Manitoba census, there were a greater proportion of Manitobans were millennials than baby boomers. In U.S. comparable data in 2015, they had 77 million baby boomers and 80 million millennials. And in the U.S. in 2015, U.S. millennials controlled about $2 trillion in liquid assets, and by 2020, that's going to be $7 trillion. So I realize that's an abstract number. Without knowing what proportion that is of total assets, it's tough to realize how relevant it is, but the growth is relevant. The amount of assets that group controls. So will millennials say the same thing about credit unions that they said about banks in those surveys? And all retailers are asking the same questions. How do we provide service? How do we meet the needs of this segment of the population? But are they a homogeneous group? Is anybody really a homogeneous group? Are the baby boomers a homogeneous group? They're experiencing similar things, but do they respond in the same way? So in the fall of 2016, the Canadian Credit Union Association, our national body, has a National Marketing Advisory Committee, and membership on that committee, by the way, in Manitoba is from Assiniboine Credit Union, Westoba Credit Union, and Credit Union Central of Manitoba. And so they began a national credit union awareness and perception study. The research included 19 focus groups held across Canada with bank customers, so non-credit union members, aged 25 to 40 that had no past or current relationship with a credit union or a case. And very high level, there was limited understanding of the credit union model among non-consumers ages 20 to 44. Banks were seen as more secure, not necessarily ideal financial institutions, but more secure. Credit unions were seen as old-fashioned, small, not necessarily full service. Even in Manitoba, and this commentary across the country, regardless of the penetration of credit unions in the various provinces with non-members, was similar. So in Manitoba, we talk about 36% market share. We have studies that show 1 in every second person has a membership in a credit union in Manitoba, as compared to, let's say, Ontario, where maybe 1 in 10 people have memberships. And yet, in spite of that penetration, amongst non-members, the level of awareness was the same. So clearly, if we're going to be successful going forward with that generation of people, we have to increase the awareness and the value of the cooperative model if we are going to be able to be as successful into the future as we have been in the past. So, these are some of the current issues that are in front of credit unions. And I tend to find myself in these presentations always seeming like I'm coming across negative with respect to the challenges that are out there, but there are many challenges out there. However, there's been challenges in different time frames ever since the credit unions have been formed. And credit unions have been very successful in Canada, especially Western Canada, and most especially in Manitoba, because we have been able to read the environment and react with business strategies that are compelling to the public so that we can grow members. And so I just have one slide here just to talk about some of the things that credit unions across the country are doing to react to some of the issues. And so this picture is the Mobile Advice Center, which is offered by Innovation Credit Union. And they say it's another free way to bank anywhere, anyway, anytime. And it's their way to basically provide service to their membership in a new and unique fashion. Federal legislation was changed 5 years ago to allow credit unions to move outside of provincial registration and provincial boundaries to be able to operate on a national basis. Coast Capital Credit Union from British Columbia is moving in that direction. Innovation, the same organization that has the mobile van, has made a commitment by 2020 to look at becoming a federally regulated organization. Meridian Credit Union, which is the largest in Ontario, has decided to create a bank subsidiary where they will offer digital banking services right across the country. We see many credit unions and some of our own technology companies that the credit union system owns are partnering with some of those fintechs that I had on that slide earlier. The largest credit union group in Canada, so a group of the largest credit unions, I should say, that represent about 50 to 60% of all the assets in credit union in Canada, have been working together for over 10 years to find ways to ensure that they can be innovative and that they can get products to market quickly. And in fact, this Deposit Anywhere application, this slide that we had where you can take a picture of your check and electronically deposit it, that was developed through this large credit union chief information officer group and actually got to market through credit unions before others. They've created a mobile debit application, which has been identified as one of the most of the best mobile debit applications that is in the marketplace today, has been piloted by 4 of the largest credit unions and will be made available to other credit unions over the next year or so. We have seen collaboration provincially. We have 24 credit unions that are working together, representing about 25% of the assets of our system, for the purposes of finding ways to streamline costs, become more efficient, look for new ways to generate revenue. We have the CEOs of the largest credit unions in the Central has been working together for 4 years to create a strategy for payments. And we talk about payments, we're talking about, obviously cash transactions, check transactions. We're talking about debit, use of your debit cards, use of your credit cards, use of your phone to make transactions. All of that work is being done to ensure the credit union system can be innovative. The credit union system understands that we need to work together and collaborate in order to be able to manage our cost structures and find new products and services that are going to meet our members' expectations. President Tito, former president of Yugoslavia, said that any movement in history which attempts to perpetuate itself becomes reactionary. I call this the look in the mirror quote. Because as soon as we start to justify why we don't need to change, we're in trouble. Jack Welch, the former CEO of General Electric, said, when change on the outside, when the speed of change on the outside surpasses the speed of change on the inside, the end is near. So we go back to the point that we have to be able to read what is going on in our environment, what our competitors are doing, what technology provides us in terms of our ability to offer services, and we need to be able to respond to that with service offerings to our members. Sam Cooke had this song in 1964, "A Change is Going to Come." Well, the change is definitely here. And I'm going to end this with an email exchange that I had with Jim Rediger, because I think the note that he concluded the email exchange on really is a summation of what my message is today. And he said that change has become a constant, technology has become the key enabler of change, and the business models we've been used to over the past decades need to change to adjust to new consumer demands and financial realities our industry now faces. I think that sums it up well, and thank you.